There's a 78-year-old woman in Riverside, California, who just cost her daughter $147,000. She doesn't know it yet. Her daughter doesn't know it yet. But the IRS knows it, because 6 months ago, this woman did something that millions of Americans do every single year, thinking they're being helpful. She added her daughter's name to the deed of her house. $380,000 house, bought for $90,000 in 1987. She thought she was avoiding probate. She thought she was making things easier. What she actually did was set up the single largest financial mistake her daughter will ever experience. And here's the thing that makes me want to pull my hair out. It would have cost $2,000 to avoid this. $2,000 to save $147,000. That's a 7,350% return. Show me a stock that does that. So here's what we're doing today. I'm going to explain exactly how this mistake works, why roughly 40% of homeowners are currently making it, and the stupidly simple fix that costs less than a good laptop, but saves your family the equivalent of a house down payment in taxes. And yeah, we're going to talk about why the entire financial advice industry somehow forgot to mention this to you. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan, and I only ask for your email to send the report so I don't store any of your financial data. Link in the description. Okay? Think of your house like a winning lottery ticket. Not the actual paper ticket, but the right to claim the prize. You bought this ticket 40 years ago for $100,000. Today, that ticket is worth $750,000. Now, you want to give this ticket to your kids. You have two options. Option one, you hand them the physical ticket while you're alive. When they go to cash it in, the lottery commission says, great, we'll give you the $750,000 prize, but first, you owe us taxes on the gain from what the ticket originally cost to what it's worth now. That's $650,000 in gains, taxed at 15 to 23% depending on your state. So your kids pay anywhere from $97,000 to $150,000 in taxes. Option two, you hold on to the ticket, you die. The lottery commission says, okay, we're resetting the value of this ticket to today's price. It's now a $750,000 ticket that costs $750,000. Your kids cash it in. Zero gain equals zero tax. The IRS literally gave you a magic reset button, and people keep refusing to use it. This magic reset button has a name in tax code. It's called Step Up in Basis. And it's the most powerful estate planning tool that exists, but only if you understand what basis actually means. Your basis is what you paid for something, plus improvements. My neighbor bought his house in 1994 for $120,000. He put in a new roof for $18,000. Remodeled the kitchen for $35,000, added a bathroom for $22,000. His total basis is $195,000. His house today, worth $800,000. If he adds his son to the deed tomorrow as a gift, that son inherits dad's basis of $195,000. When the son sells for $800,000, he has a gain of $605,000. At 23.8% combined, federal and California state capital gains rate, that's $144,000 in taxes. But if dad just does nothing, holds the house until he dies, and passes it through his estate, the son gets a stepped up basis of $800,000, sells it 6 months later for $800,000. Gain, zero. Tax, zero. Dad saved his son $144,000 by literally doing nothing except not screwing it up. Now you might be thinking, but probate is expensive and takes forever. Everyone says to avoid probate. Here's where it gets really interesting. Probate in most states costs somewhere between $3,000 and $8,000. It takes 6 to 18 months. It's annoying paperwork. I'm not gonna lie and say it's fun. But let me ask you something. Would you pay $8,000 to save $144,000? Because that's the trade you're making. You're so terrified of an $8,000 probate bill that you're volunteering to pay the IRS $144,000 instead. It's like being afraid of a parking ticket, so you just set your car on fire to avoid the parking meter. The math doesn't math. And this gets worse, because giving your house away while you're alive doesn't just destroy the tax benefit. It opens up 3 other catastrophic risk channels that nobody talks about. First, lawsuits. Your daughter's name is on your deed. She gets in a car accident. Somebody sues her for $2 million. Guess what just became part of her asset column? Your house. The house you paid off over 30 years. The house you raised her in can now be seized to satisfy a judgment against her. You just took a protected asset and threw it into the legal thunderdome of your kid's life. Second, divorce. Your son's name is on the deed. He goes through a divorce. In most states, that house is now part of the marital estate. His ex-wife can claim half of it in the settlement. You could literally end up with your son's ex-spouse owning half your house. The house you bought in 1983, half of it now belongs to someone you met twice at Thanksgiving and didn't even like. Third, creditors. If your kid has a business that fails, files bankruptcy, gets into debt trouble, that house is fair game. Every financial mistake your child makes now has a claim on your biggest asset. But wait, there's more. And this is the part that actually keeps me up at night. Once you put your kid's name on that deed, you can't just take it off. You need their permission. They have to agree to sign it back to you. What happens if you need to sell the house to pay for long-term care? Nursing homes cost $10,000 to $15,000 a month. You need liquidity. Your kid says no, or their spouse pressures them not to sell because they want to inherit it. You're 79 years old, you need care, and you're now hostage to your own child's financial interests. I watched this exact scenario destroy a family in my business circle 2 years ago. Father added daughter to the deed in 2020. By 2024, he needs memory care, costs $14,000 a month, wants to sell the house to fund it. Daughter's husband convinces her not to sign because they're planning to retire in that house in 10 years. Father ends up in a state facility on Medicaid. Daughter got the house. Father got a shared room with a stranger and hospital food. That's the trade. So if gifting the house is financial suicide, what's the actual solution? You create a revocable living trust. This is not complicated. This is not some exotic offshore structure. This is basic estate planning that every competent attorney knows how to do. You create a legal document called a trust. You name yourself as trustee, which means you control everything. You transfer your house into the trust by signing a new deed. You name your kids as beneficiaries who inherit when you die. Done. During your life, nothing changes. You still control the house completely. You can sell it, refinance it, take out a home equity line, do whatever you want because you're the trustee. But when you die, the house doesn't go through probate because the trust owns it, not your estate. It passes directly to your kids according to the trust terms. No court, no waiting, no probate fees. And here's the critical part. The house is still included in your taxable estate for IRS purposes, which means your kids still get the full step up in basis to fair market value at your death. You avoided probate and preserved the tax benefit. This is the only correct answer. Let me give you a real scenario with actual numbers so you can see how this plays out in practice. Meet Richard. He's 68, retired engineer, owns a house in Phoenix, bought it in 1991 for $135,000. Put in $90,000 in improvements over the years, total basis, $225,000. Current value, $900,000. Richard has 2 daughters. He's thinking about adding both their names to the deed so when he dies, they automatically inherit without probate. Let's run both scenarios. Scenario A. Richard adds daughters to deed now. They inherit his basis of $225,000. Richard dies 5 years later. House is now worth $950,000. Daughters sell it and split the proceeds. Their gain is $725,000. At 20% federal capital gains rate, plus Arizona's 4.5% state rate, that's 24.5% total. Tax bill, $177,625. Each daughter nets $386,187 after tax. Scenario B, Richard does nothing. Creates a revocable living trust for $2,500, transfers house to trust, still controls everything during his life, dies 5 years later. House worth $950,000. Daughters inherit with stepped-up basis of $950,000. They sell for $950,000. Gain, 0. Tax, 0. Each daughter nets $475,000. By spending $2,500 on a trust, Richard saved his daughters $177,000 in taxes. That's an 8,810% return on investment. Find me another investment that does that. You can't. It doesn't exist. This is where it gets really interesting, because now you're asking yourself, why isn't everyone doing this? Why do I keep hearing about people making this mistake? 3 reasons, and they're all about incentives. First, ignorance. Most people genuinely don't know how step-up in basis works. It's not taught in school. It's not something you learn unless you specifically study tax law or estate planning. So people default to what sounds intuitive. Put your kids on the deed to avoid probate. It sounds logical until you understand the tax code. Second, bad advice from the wrong professionals. Your real estate agent tells you to add kids to the deed. Your real estate agent is not a tax attorney. They know how to transfer property, but they don't understand the tax implications. It's like asking your dentist about your knee pain. Wrong specialist. Third, and this is the cynical part, there's no incentive structure pushing this information to you. Estate planning attorneys know about this, but you only talk to them if you already know you need estate planning. There's no marketing budget behind revocable trusts. Nobody's running Super Bowl ads for step up in basis. But there are entire industries built around real estate transactions, probate, and tax payment. The system benefits from your ignorance. Here's a quick aside that makes this even more absurd. I have a friend who works in probate law. He told me that roughly 30% of his cases are families dealing with assets that were gifted before death, specifically to avoid probate. They avoided a $5,000 probate process and walked into a $150,000 tax bill. He said the conversation is always the same. The family sits down, he explains the capital gains tax they now owe, and someone always says, but Dad was trying to help us avoid probate, and he has to tell them he did. You avoided probate, but you also volunteered for a tax disaster that's 30 times more expensive. Then there's this great moment of silence where everyone realizes what happened. Dad tried to save them $5,000 and cost them $150,000. It would be funny if it wasn't so tragic. The other thing nobody tells you, this isn't just about houses. This applies to stocks, rental properties, business interests, any appreciated asset. I know a guy who inherited stock from his grandfather. Grandfather bought 10,000 shares of a company in 1972 for $3 a share, $30,000 investment. By the time grandfather died in 2022, those shares were worth $400 each, $4 million. Because the grandson inherited through the estate, he got stepped up basis of $400 per share. He sold half the shares the next year to diversify, $2 million sale. Tax? Zero, because his basis was $2 million. If grandfather had gifted those shares while alive, the grandson would have inherited the $3 per share basis. Selling $2 million worth of shares with a basis of $15,000 would have created a gain of $1,985,000. At 20% federal rate, that's $397,000 in taxes. Step up in basis saved him nearly $400,000. On stock, same principle, bigger numbers. But now you might think, okay, I get it. I need a trust. But what if I can't afford an attorney right now? What if I'm young and don't think I need this yet? Here's my answer. If you own a house worth more than $200,000, you can afford a $2,000 trust. You're sitting on a 6-figure or 7-figure asset and you're telling me you can't find $2,000 to protect it? That's not a money problem. That's a priority problem. And if you're young, this is exactly when you should set this up. You're not doing this because you're about to die. You're doing this because life is unpredictable. Car accidents happen. Heart attacks happen. Cancer happens. I don't want to be morbid, but I've been around long enough to see people in their 40s die unexpectedly, and their families are left cleaning up an estate planning mess because they thought they had time. You might have time, you might not, but if you do this now, it's done. You don't have to think about it again except for minor updates every few years. Let me give you the 3 specific action steps that matter because I want you to leave this video knowing exactly what to do. Step 1. Do not add your children's names to your deed while you're alive. If you've already done this, call an estate planning attorney this week to discuss reversing it. This is not optional. This is financial triage. Step 2, find an estate planning attorney in your state. Not a general practice attorney, not your real estate closing attorney. Someone who specializes in trusts and estates. Ask friends for referrals. Check online reviews. Schedule a consultation. Most will do an initial consultation for free or a few $100s. Tell them you want a revocable living trust to hold your house and other assets. They'll walk you through the process. It takes 4 to 6 weeks typically. Step 3, actually fund the trust. This is where people screw up. They pay for the trust document, they sign it, and then they forget to transfer assets into it. The trust doesn't do anything unless you put assets in it. Your attorney should help you with this. You'll sign a new deed, transferring your house from your name to the trust's name. You'll update beneficiaries on retirement accounts and life insurance. You'll make sure the trust actually owns what you think it owns. This step is not optional. An unfunded trust is just expensive paper. Now, let me address the objection I know some of you are having. This sounds complicated. I don't want to deal with this. Can't I just leave everything in my will? You can. Wills work, but wills go through probate. So you're back to the original problem. Your family pays probate fees and waits months for court processing. A trust avoids all of that. And honestly, setting up a trust is not that complicated. It's less complicated than buying a house. You did that already. You can do this. The attorney does most of the work. You just sign documents. And once it's done, it's done. You don't think about it again, except for periodic updates. The really sick irony of all this is that the federal government created step-up in basis specifically to help families transfer wealth without getting destroyed by capital gains taxes on decades of appreciation. It's one of the few remaining wealth transfer tools that actually works in your favor. And millions of people are accidentally opting out of it because they don't understand how it works. The IRS literally built you an escape hatch, and you keep walking past it into the fire because someone told you probate was scary. Probate is not scary. A $150,000 tax bill is scary. I've been running my own businesses for over a decade. I've worked with accountants and fiscal lawyers who taught me how money actually moves and where it gets trapped. And the single most consistent pattern I've seen is this. People make massive financial mistakes not because they're stupid, but because they don't understand the incentive structures and they don't read the boring documents. The tax code is boring. Estate planning is boring. But boring documents govern where your money goes. And if you don't understand them, someone else will. And they'll use that knowledge to take your money legally. In this case, the someone else is the IRS. And they're perfectly happy to let you volunteer for a $150,000 tax bill because you were afraid of an $8,000 probate process. Here's the final piece that really drives this home. I have hundreds of thousands of dollars invested. I'm not some theoretical finance guy telling you what I read in a book. I'm telling you what I do with my own money and what I've watched successful people do for years. And every single person I know who has built real generational wealth has their assets in trusts. Every single one. Because they understand that wealth building isn't just about accumulation. It's about protection and transfer. You can make $10 million, but if you lose half of it to taxes during the transfer to your kids, you didn't actually build $10 million of family wealth. You built $5 million. The other 5 went to the government. And that's fine if you want to donate to the federal budget. But I'm guessing you'd rather your kids have it. Lazy investing built more fortune than crypto memes. And part of lazy investing is understanding that sometimes the best move is the boring move. Set up a trust. Transfer your assets. Let the step up in basis do its job. Don't try to be clever. Don't try to outsmart the system. The system already gave you a gift. Just don't refuse it. So here's where we are. $2,000 for a revocable living trust saves your family potentially $150,000 to $200,000 in capital gains taxes. It avoids probate. It protects your assets from your children's lawsuits, divorces, and creditors. It preserves your control during your lifetime. And it gives your kids a stepped up basis that resets the cost to market value at your death. This is not complicated. This is not risky. This is basic estate planning that every homeowner should have. If you own a house worth more than $300,000 and you don't have a trust, you're gambling with 6 figures of your family's money. That's not financial planning. That's financial roulette. Don't gift your house while you're alive. Put it in a trust. Let your kids inherit it with step up in basis. Simple, boring, effective, the end.